This is insane. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the government's new orders to the banks will blow your mind because this is intimidation tactics at the highest level. I'm going to show you what the government's ordering the banks to do and why it's going to completely backfire on the government. Plus, one expert is saying the Fed is about to reignite funding stress in the system, and I'm going to show you how the system actually works and why the Fed is going to react to what we're going to see in the near term as another round of stress that could send equity markets crashing again. Now let's head over to Bloomberg, where we picked today's story up with a headline. As China asks state banks to keep record of government bond buyers, and this is something that's never happened before in history. And something we've noted is Beijing has been attempting to control the long end of their bond curve and drive yields higher. And the reason they want this is because money is flowing out of China to other countries, particularly the United States, which has higher interest rates, and that is attracting money and pulling it out of the country, and this is something they desperately need. You know, China is used to having money flow into their country to support their economy, and so Beijing believes if they can drive long-term interest rates up, that will actually keep money there. The problem is, just like other governments and central banks around the world, they're finding out very quickly they have absolutely no control over their bond market. Financial regulators this week told state-run banks to log the details of the counterparties that purchase long-dated government bonds on a daily basis. It's the first time such a request has been made to lenders involved, according to insiders. Beijing is widening its battle against bond speculators, targeting everything from fund houses to rural banks in a bid to push government yields higher from record lows. And sinking bond yields have authorities on the edge, as any sudden reversal could send shockwaves through the economy. And this is the government's perspective, is they believe that there's a lot of people speculating on the bond market there in a short position. And they believe that if there's an increase in rates, which they're trying to accomplish, that this would cause financial havoc. Not much different than what we saw with the yen carry trade, but this is what the Beijing actually believe. But again, it has really nothing to do with the bond market so much. It's everything to do with trying to attract and keep money in their financial system. But what they don't understand, and what virtually no government or central bank around the world seems to get, is that long-term interest rates are not a function of government intervention. It has everything to do with growth and inflation expectations. And this chart here is very clear on that. As we take the consumer price index and real gross domestic product, we're going to look at U.S. data, and we're going to average that together and put that in blue on a year-over-year rate of change, and that's going to give us a proxy for economic growth and inflation. And I'm going to put that up against 10-year treasury yields, as you see here in red, and you can notice there's a fairly good relationship between the two. Where growth and inflation expectations go, will interest rates follow. Although this is one time the market has said, no, that's not the case. We're going to continue to drive yields higher despite the fact that growth is slowing. And that is dangerous because in a debt-based economy, if you want to spur consumption, well, one thing you need is you need to see interest rates go down to a level where consumers and businesses want to borrow, they want to spend, they want to invest, and the problem is it's not working at these levels here in the US, nor is it in China. So as we look to China's economy, we see it slowing just as we see other economies around the world. And why Beijing wants interest rates to go up, it's absolutely not going to happen because, again, they have no control over the long end of the curve. But one thing you have a lot of control over, and that's how you make money in the markets. And right now, we're putting up some incredible trades. We're taking a look at one of our CTA Timer Pro reports, because if you want to beat the machines, we put out a ton of trades, because what we see here is we scan across equity, bond, commodity, and currency markets every day around the world. We look for when the machines are in deep short position and prices rallying against them. And here's the best part. Right now, there is one sector of the investment world that is bottoming out and getting ready to boom. While everyone's focused on tech stocks, our subscribers are getting ready to make a fortune. In fact, some of our trades are up already. Just been on the books a couple of days. We're seeing over 1% moves. One of the trades up over 5% in 2 days. And here you can see our Momentum Timer Pro report. Also, if you like to trade momentum, but you find yourself getting in late and out early. We look at momentum over long periods of time, but what makes us unique is we aggregate all these technical signals together and we run a proprietary overlay to smooth it out. When we see big pullbacks in momentum, as we see here on our 1 month window, and then it's change from sell to buy, well, we know that is the shift. And here's how you can do it. You want to duplicate our trades? You can duplicate them exactly the way we do, because we give you the reports every day, the tradable signals, and you can pick the ones you want, or you can take my opinion and I go through every trade and tell you the ones I think you should do. I give you stop loss levels. We track the trades and returns. Again, you can duplicate these, and every weekend we update our stop loss levels. Here's the best part. Not only can you duplicate this and make more money trading and get in on the right cycle of the market, we give you 30 days free. How about that? Links in the description below. Because authorities in China have been seeking to limit risk at its financial institutions, where the collapse of Silicon Valley Bank, which piled into U.S. treasuries before rates rose. And this is extremely misleading by whoever wrote this article, because what happened back during the pandemic is rates around the world crashed, and banks, of course, had to buy all these bonds, particularly since there was a lot of lending actually going on as government forced things like PPP loans into the system. And then it wasn't the fact that they bought the bonds at a low level and rates went up. It was a fact that central banks drove rates significantly higher. So we look to China and say, well, are you on the cusp of some sort of pandemic? The answer is no. You're on the cusp of what's going to be a recession at the very least, if not based on your banking system and real estate sector, an all-out financial crisis. But we can make the case of why interest rates are actually going down and why this is just intimidation factor coming out of Beijing. Because when we go back to the U.S. data, and we can see what's going on around the world, is central bankers have inverted something called the yield curve. And that's here in blue. When we look at 10-year yields, less 2-year yields, and when it shows below this horizontal black line, what it means is that 2-year yields are higher than 10-year, and that's abnormal. That means, of course, policymakers are influencing the bond market in a way that normally wouldn't happen. And what you see after these inversions, you see the blue line steepens. Well, that's called a bull steepener in the bond market, because what that means is rates come down. Here you see 2-year treasury yields in red, and you'll note that every time after an inversion, what happens is rates come down. And while U.S. investors believe this time is different and the rates need to go significantly higher, and again, toward the end of the show, I'm going to teach you how the system really works, what the yield curve is suggesting as we get edging closer to a breakout into a bull steepener, that rates here are about to come crashing down. And that's the same for China. Because when you think about a debt-based economy, and this will be very important when we get to the part later in the show where we discuss how the system works, is if you're trying to create money and grow, well, if you can't get people to borrow at current rates, well, then sending them higher isn't going to help. They need to come down, and that's exactly what the inverted yield curve says, that we constricted the creation of credit, and we've done it for so long that now the system's starting to run out of money, and when it does, the only way to create it is to get people to borrow, and that means rates come down, despite the fact that Beijing wants them up. And while the central bank is yet to follow through on its pledge to borrow government bonds and sell them directly in the market, it's now turning to intimidation factors as some state lenders unexpectedly, well, we won't say unexpectedly, more likely they've been pressured by the government to do this. As they sold 7-year bonds this week to push up yields, they also actively sold 10-year notes earlier in the week. And here we can see why it's just not going to work, because as we focus on, again, how a debt-based economy works, if you want to create lending growth, then interest rates need to be at a level that the economy wants to borrow at. And if you see lending start to contract, well, this is dangerous, because money is created when people borrow from a commercial bank. But at the same time, as a loan is paid back, the principal value is destroyed from the system. And so when we look at the weekly data for commercial industrial lending here shown in blue, again, this is US data. This is from a weekly data this series. What we see this now on a year-over-year rate of change, there's virtually no lending growth going on here in the United States out of the commercial banks. Now there is lending, but offsetting that is all the loans that are being paid off that came in at much lower interest rates. And so you can see here against 2-year treasury yields, as demand for lending slows down and then turns negative into contraction, and that means money is being destroyed, look what happens to interest rates. They start to go down. And you see this relationship happen over and over, and it makes perfect sense. Why? Because rates right now are too high to compete against what we see for demand for lending. So this tells us that rates need to go down to spur the creation of money. And the problem is, the longer the Fed keeps rates up and the longer investors keep betting against the bond market, the bigger disaster the U.S. economy is going to face. And this isn't going to be limited to the U.S. We're going to see this happen in China and Europe and every major industrial country around the world, because the fact is, at some point, when you drain the system for money long enough, you don't just get a recession, you get a financial crisis and a collapse in assets, and that is dangerous. Right now, with everyone levered into the U.S. equity market, something policymakers don't want to see, but is going to happen. And among other tactics in Beijing's playbook, regulators were reported to have slowed the approval for new bond funds, and local authorities in one of the most affluent provinces asked some rural lenders to suspend trading in sovereign notes. So they're trying to get rid of demand for bonds. But the issue here is, why do banks want to buy bonds? Why are we even seeing that happen? Because as lending growth slows, and we looked at that chart, what happens is banks need to back deposits with some sort of interest-bearing asset. Now, ideally, they would love to back it with a loan because they make more money. And if they're not confident about their ability to get money back when they lend it out, they turn to government bonds and lock that rate in. And all we're seeing here is the banks are buying into the narrative that growth and inflation expectations are indeed coming down. The governments are trying to say no, particularly Beijing, this isn't happening. But as we look at their economy, there's no question they're headed down. And China is walking a tightrope between supporting growth and trying to rein in a sizzling debt rally that earlier this week sent benchmark yields below 2.1% for the first time in history. Although analysts have said any intervention won't likely yield long-term results, as expectations remain high that Beijing will have to trim interest rates to further bolster the economy, and that's exactly my point. These inverted yield curves are telling all these central bankers around the world, whether you like it or not, you're going to be lowering interest rates and far faster and deeper than you're expecting. And if you don't, you're just going to blow up your economy anyways, and that's what's about to happen in China. And we can see here again, as we try to create demand, it's all about interest rates in a debt-based economy. As we look at advanced retail sales, here we are in the U.S. data, this shown in blue, on a year-over-year rate of change. And you can see slowdowns in retail sales. Well, how do you get people to go out and spend, particularly in an economy where people borrow money they don't have to buy things they don't need? Well, you notice rates come down each and every time we start to see a slowdown, because the bond market is saying, look, we need to spur growth. This is one case where retail sales are continuing to decline. The Fed and investors and speculators are saying, no, we need to keep rates up. The problem is, you keep them up too much longer, and by the time we find out that retail sales are actually plunging in a way we can't stop them, it's going to be too little, too late. The Fed will react, but it won't matter, because by the time we get there, the damage will already be done. And as one expert says, all this means is more funding stress, like we just saw, is coming back the next time at the hands of the Fed. As rate cuts hopes raise risk of reigniting funding stress, the recent drop in short-term rates has put pressure on the reverse repo facility at the Federal Reserve, potentially bringing nearer the timing of funding stress to reemerge when the Fed ends quantitative tightening. Now, keep in mind, the Fed has already scaled that back. At the current levels, they have enough bonds maturing to run their program, but many people believe they're going to have to go back to quantitative easing. And in fact, I am one of those people that actually believe that, but the size and scope of it is going to far outpace what we've ever seen in history. Let's continue on, because a carry trade, referring to the yen carry trade unwind, may have taken center stage this week, but other ongoing potential sources of problems should not be neglected. One of them, which is the decline in the reverse repo, the domestic facility reaching a 3-year low of $286 billion, is happening on Wednesday. Now, we're going to look at a chart of this here in a second, but I want you to understand what the overnight reverse repo is actually used for. So when you see money market funds that cannot get enough collateral, which is T-bills, and if you go look at the money market fund, what they're required to by law to buy, it doesn't say treasury bills, but it might as well, because everything it describes, the only answer is they need to buy T-bills. And in a rising rate market, or in a market where there's a shortage of T-bills, well, money market funds still need to pay their depositors, and so they turn to the Fed, where they park it on an overnight basis, and the Fed pays them interest. And so many people believe if you drain the reverse repo, something dangerous happens. I'm going to show you why it does, but not for the same reason they believe. So what we're seeing now is the reverse repo actually decline, which is exactly what should happen. It means either there's enough collateral coming into the system, or that money market funds actually start to believe that rates are coming down. And reserves are closing in on the $3 trillion level the Federal Reserve Board member Christopher Waller has touched upon at the lowest comfortable level of reserves, where they believe funding problems could manifest. This is interesting because I'm not going to show you a chart of this, but what they're talking about in terms of bank reserves is a lot to do with the fact of how much money the Fed has on its balance sheet. And the Fed wants us to believe in this mystique that you need a certain level of reserves in the system, and they're the ones that control it. But we know there actually means nothing. And that's why we're not going to look at a chart, but we're going to focus on this reverse repo issue, because the expert here says it represents a buffer on top of the current level of reserves. And this is not true. It has everything to do with money markets, because here he says it's principally money market funds can draw down it, adding to reserves in the process. And that's not the case really at all. The money market funds, again, only buy T-bills, and they really only care about the direction of interest rates. When they're rising, they don't want to own them because they tend to lose money, and they would rather go to the Fed for overnight money. When they're stable, they're happy to own them. And when rates are declining, well, they really, or when they think rates are declining, they really want to buy a lot of them. And whether the reverse repo will go to zero is a moot point, as money market mutual funds may choose to keep some reserves in there as a convenient facility they may want to lose access to. That's not the case at all. The Fed isn't going to close the overnight reverse repo, so keeping money in here isn't going to keep the Fed in play. If the Fed wanted to close it, they could simply do that in any meeting coming forward. But nonetheless, money market mutual funds whose assets recently reached a record have been drawing down the reverse repo this week, most likely to beginning to look less attractive from a yield perspective. And now we're starting to get to the heart of the issue here. The reverse repo currently pays 5.3% on an overnight basis, but if the Fed cuts interest rates as priced, it will drop sharply in the coming weeks and months, suggesting that if you're a money market fund and you actually believe the Fed is going to cut rates, then you want to start going out and buying 3- and 6-month T-bills, and that will send rates down. And sure enough, what we see here is exactly that, where money market funds start to realize, as you see here in the 3-month yield, that if the Fed's going to cut, that they start driving yields down, and that pushes the Fed to actually make the decision. Because as pressure grows on reserves, as reverse repo is now less able to soften the blow from the balance sheet reduction, the time when QT is either further curtailed or ends draws closer. And that will, of course, only happen in a financial crisis. The U.S. banks in the main see the policy ending this year. However, the best laid plans can go awry. However, the best laid plans can go awry as the closer reserves reach to their lowest comfortable level, which is impossible to know, which is absolutely true, the greater possibility of funding market stress. But let's talk about funding market stress here, because if we look at overnight reverse repo, what we're seeing is now there's enough collateral coming into the system where we don't need the money market funds to go on to the reverse repo to get a yield. So what that indicates now is we see this drain down, then what that tells us that there perhaps is more collateral in the system than there is money. And that is a problem, because many people would interpret that as, well, rates need to go higher. Not the case at all. Because remember earlier, we're talking about a debt-based economy. If you have a shortage of money, which way do rates need to go? Well, they need to go down, and that's exactly what we're starting to see here. We go back to 2017, 2018, what happened? Reverse repo got drained down, and eventually rates came down. We see that happening here again. And with with the government running massive deficits and issuing a lot of debt, we need to have enough money to back it up, suggesting that while everyone believes rates in the U.S. are going to stay elevated and that perhaps only a quarter or a 50 basis cut is needed, what we're seeing in the system is funding stress is rising. And when rates start to come down, it means financial conditions are tightening. And the reverse repo, if it gets down to zero, could be the first indicator that we're about to experience a whole nother round of a crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.